Good morning all, and many thanks for joining today's webinar titled Tax Time and the Financial Year Business Tax Planning Strategies. Thanks for joining us. We've had a lot of interest in this topic, which no doubt certainly has a bearing on every one of us, and particularly those of us in family businesses. We trust that you find today's content very relevant and very meaningful. Just before we begin, just a usual disclaimer, the advice given today is general in nature and not to be substituted for tailored advice for your specific situation. So, who are you? We're Quantum Advisory, a tax and accounting advisory firm. I'm Gavin Teef, one of the directors here. With me today is Senior Business Services Manager, Sam Baker. So, Sam, what's on the agenda?
Thanks, Gavin. So we'll be going through a budget wrap, a bit of a review of the budget that was released a week or two back, and then some 30 June tax time actions to take in view of optimising the tax position of your business. We'll be looking at a balance sheet review for some key items that need to be assessed for every business out there, and then we'll have a quick look at the opportunities for both companies and trusts in this current tax season. So I'll kick off with the budget wrap. I think Gavin, you're going to tell us what the opportunities are in the current budget for small businesses.
Yeah, so I'll just put in front of you now is really a summary of the good news for small business in the budget, which as you can see is a blank slide. It was a very, very lean budget in terms of good news for small business. There wasn't really too much to report at all, unfortunately, despite the times that we find ourselves in and the fact that the SME sector is the nation's biggest employer. But Sam will unpack this in a bit more detail.
Thank you. It's a bit unfortunate there wasn't something more available for us. But the first thing we wanted to look at was the stage 3 tax cuts. So there was a lot of people were predicting there might be some change to this, but the government has let it slide with what was already legislated a couple of years back by the previous government. So as it stands, we've got the 5 separate tax brackets there, and in the 24-5 financial year, it's already legislated to effectively wipe out one of those tax brackets. So it'll be, as you can see, there'll be one bracket right through from 45,000 right through to 200,000, and then it'll be 200,000 plus rather than 180,000 plus. So that'll result in some tax savings for a lot of individuals, quite a few of our clients. So as you can see, for somebody with an income of 200,000 in that 24-5 financial year, it'll be a tax saving of just over $9,000 compared to what it previously would have been.
It's good, certainly a good initiative, and to see 30% the maximum tax rate applicable right up to 200,000 is certainly welcome news.
Absolutely. And there were some changes to the instant asset write-off. Obviously, as we know, through the COVID period, as part of the stimulus packages, the government brought in what was known as temporary full expensing, which was government businesses up to $5 billion were able to instantly write off or depreciate assets of any value. This has been wound right back. So as it stands from 1st of July this year, businesses under $10 million turnover will be able to instantly write off assets up to $20,000 each. And then for businesses over $10 million turnover, it's gone right back to first principles, really. So anything over $300 we have to be depreciated using the ATO's rates. So it's going to up the compliance burden for small businesses, unfortunately. But yeah, that's what we've got to work with.
It is a shame, and even for those under 10 million, the rate set there at $20,000 wouldn't even allow for the write-off of a new vehicle, would it? Which is a bit unfortunate, but that's what was announced.
Absolutely. So there was also some updates as to superannuation. So obviously the one that was already legislated was the super going up an extra 0.5% from this coming July. to 11 from 10.5. And the big change that was a bit of a headline, but it won't really have any impact for the time being, was payday super. So to date, super's been payable 28 days after the end of each financial quarter. The big change will be from 1st of July 2026, when super will be payable each payment date. So that will be, if you pay obviously weekly, fortnightly or monthly, you'll be paying super on payroll day. So that'll be quite a change, and it's to avoid employees missing out on super payments. And then there was also thrown up in the budget the additional tax on large super balances, individual balances over $3 million. It's only from 1st of July 2025, but can you run us through some of the key points of that one, Gav?
Yeah, so this has been in the press quite a bit. It certainly isn't ideal. That said, the $3 million does apply per individual. So if we're looking at a couple, we're talking a combined super balance of $6 million, so it certainly won't apply to everyone. A couple of key parts to it. One is that the $3 million is set not to be indexed ever, which means that as years roll on, that real value is going to significantly reduce as inflation increases over the years. And then the other point about it is that the additional tax applies to income that's not realised, which is another fairly nasty piece of this announcement, that if you've got, say, a share portfolio or a property that may have gone up significantly and your super is beyond the $3 million, you'll be paying an additional tax on income that's not yet realised. And this could be very problematic, particularly if you've got a super balance that because of market movements could be pivoting above $3 million and then back under, then above again. There is potential there for double taxation and a whole lot of issues. I'm sure we haven't heard the last of this yet in terms of changes to it, but as it's been announced, they're the broad features of it, which are far from ideal. It's something we need to put some thought to over the next couple of years if you have super of that sort of scale.
Yeah, what it does also raise the possibility of is tax on effectively cashless income. So if you, for example, you have a super fund that's sort of low on cash but is invested in property that's moving up in value, you could get taxed on that uptick in property value, but no extra cash may have been generated.
Exactly right.
So the next point we were going to mention was there was fairly significant extra funding added for the ATO to pursue compliance activities. So that will likely manifest itself in an increased number of audits and pursuing debts and lodgements over the coming years. So there's something to keep on the front foot with. So could you run us through some of the actions that we should be taking before 30 June in our businesses, Gavin?
Yeah, thanks, Sam. So I've already sort of touched on this, just the whole issue of temporary full expensing finishes up in June of this year, as we know. There's just a couple of features of that we just wanted to touch on. Obviously, it's going to make for a flurry of activity and acquisitions between now and June 30 for those that want to capitalise on it. The $5 billion turnover threshold is still there until June 30, but just bear in mind that the threshold for second-hand assets is 50 million. So if you're above 50 million, this only applies to brand new assets. The other feature of it is that it does exclude some assets, so new buildings this doesn't apply to, and there's a range of software products that it doesn't apply to. I just really wanted to articulate this last point, that it needs to be installed and ready for use, which I think the way the land lies at the moment, I think a lot of people are set to be caught out with this. Supply chains have been difficult, and you could well have ordered, say, a new machine that's coming from overseas, it's delayed shipments and all the rest of it. You could end up in a position where you've ordered it and paid for it, but if it's not installed and ready for use by 30 June, you miss out completely on the instant asset write-off, and you'll be back to the usual ATO depreciation rates for that, even though you looked ahead, paid for it and ordered it well before the 30 June deadline. So simply having an invoice from the supplier for a new machine or new piece of equipment doesn't make you eligible for this concession. It needs to be installed, ready for use. That's something that they do place quite a lot of emphasis on.
And just like to make a note that it's not worth purchasing new assets just for the tax deduction. You've just got to be able to mount a strong business case.
Yeah, certainly not. We're not going to buy assets just to save some tax. It does have to be a strategic purchase that's going to work for your business.
That's good. So we wanted to talk about the compulsory obligations for payment of super for employees, and then also the opportunities that come along with it. So as we know, super payable for employees is tax deductible when it's actually paid and when the employee's fund receives it, rather than when the liability is raised. Now, that means that if you pay your super on a quarterly basis, the June quarter super will only be deductible effectively when it's paid on bit before 28th of July, which is the statutory due date, rather than actually when it's brought up. So this example shows that there's $20,000 of super accrued in the June quarter, and the business wants to bring forward that tax deduction, so they pay it, around the 20th of June. It hits the employee's super funds before June 30. That means the business can claim a deduction for that extra 20,000, which brings forward it effectively gives them a tax saving for this 2023 financial year of $5,000 at the company tax rate. So it's quite an incentive there to pay it early if you've got the cash flow available. It allows you to get on the front foot with that deduction. And the other point we'd like to make is that there's some fairly harsh penalties for late payment of super. So paying it after the statutory deadline of 28 days after the end of the quarter can mean your business can incur some pretty harsh penalties, which is a massive disincentive for that. So keep an eye on that.
That's good, Sam. Certainly super has to be paid either way. It's just a timing issue. So if you can bring forward a tax benefit in this example of $5,000, well, why not?
Exactly. So, yep. That's good. We also wanted to highlight the potential of additional super contributions. So obviously each individual has a limit of $27,500 they can put in each year to super. As long as they put that in before the end of the financial year, they can claim a deduction in their individual tax return at their own marginal tax rate for that. Just good to keep in mind what's called Division 293 tax. So if the individual is earning assessable income of more than $250,000, that contribution will incur an extra 15% tax on that. So it makes the extra deduction a little bit more marginal than it would have been, but it's still a benefit generally. And the other point we wanted to note was what's called the downsizer contribution. So if you're 55 or older and sell your main residence, you can deposit up to $300,000 into super, and there's some fairly significant concessions on that, isn't there, Gavin? Can you pass through that?
Yeah, that's good. And the other point to highlight on this is that, once again, if it's a couple, you can effectively get $600,000 into super. There is some fairly tight time constraints. So if you sell a property, there's a fairly tight time limit on making that contribution into super. But one thing that's interesting about the way it's been drafted is that you don't need to be actually downsizing house in size or value. So you could sell your property and buy one that's more expensive, but it still opens the way to being able to make this one-off $300,000 contribution. So mightn't fit everyone's situation, but if you're over 55 and trying to maximise the amount you've got in super in the run-up to your retirement, it certainly is just another opportunity to be able to get some more money into a tax-friendly environment.
That's good. And so this is just a simple worked example of a guy called Barry, who's 55 and has taxable income of $210,000. So there's $180,000 of standard wage and salary income, and then an extra $30,000 investment income. He's got a portfolio. So he's on that income. He's on the top marginal tax rate of 47%. And obviously Barry's already getting about 18,900 of super contributions paid by his employer on his wages. But he decides to put in up to his maximum of 27,500 concessional contribution. So that's an extra 8,600 he can put in. He claims a deduction for that of 4,042. And then there's obviously 15% tax taken on that in the super fund. So the super fund will be paying 1,290 tax on that. But still overall his net tax saving is a bit over 2,700, which is the difference between, what he can claim back individually compared to what the super fund's paying on that money, and he ends up with more money in super for his retirement. So he's setting himself up long term, but gets a good tax outcome now.
Yeah, it's good, Sam. Certainly a very common strategy is to max out that tax deductible portion each year.
Absolutely, you do just have to keep in mind the amounts that are being put into super off wage and salary income that you're earning. So
exactly right.
To review that. Could you run us through a quick balance sheet review, Gavin?
Yeah, so I just might touch on some of the balance sheet related items that certainly have an impact tax-wise. The first thing we wanted to look at was the issue of a stock take. As everybody knows, that's in a trading business. Stock take is, generally speaking, no fun and can certainly be a monumental task. But just wanted to reiterate this point that when it comes to the actual valuation of stock, these three methods can be used: cost replacement value and net realisable value. Now, I think what we see a lot of is come stock take time, we tear around the warehouse and count up the number of products that we've got, have a quick look at what we paid for them and drop those into a spreadsheet, let one multiply by the other, and there's our stock take, which hopefully keeps our accountant happy. Just to look into that a bit further, this concept of cost replacement and net realisable value can be assessed on a line-by-line basis. So I guess this is a typical stock take of what we often see. We've got, in this case, 7 products. We've got the quantity on hand, the cost per unit. Cost tends to be the default method that is often just reverted to, simply because it's probably the easiest, and it's just a matter of looking up what we paid and there's our number. So I can see in this case, looking at those quantity numbers and cost per unit, that we've got in ABC Co here, we've got a stock take of 423,000. Now, as we all know, the value of stock effectively comes off our cost of goods sold and is added back to our profit effectively for tax purposes. So therefore, the lower the stock figure for tax purposes, the lower the taxable profit. If we have a look at this second example, this is the same business, but potentially employing some different valuation methods. And to demonstrate this point that these methods can be used on a line-by-line basis. So we can see from that example that looking at the first 2 products, that cost is the most appropriate way of doing it. The third product, market value, is more appropriate, and that gives us a figure that's below cost by 20%. We can see that product 4, we're going to use replacement value. That could be because it was a product that's since been superseded by some other product, and the replacement cost is now much lower. And so we've reduced that by, say, 50% to allow for that. Product number 5, we might decide that cost is okay. Then product number 6, we might say, well, okay, we're going to drop that by 2/3. It could be, for example, an item that, say, for example, you were selling light fittings and you were selling an older style of them. And it could well be that a new one's come out that's LED and much better and more efficient and cheaper, that's now flooded the market. Well, that might be reason to drop the value of that stock to market value, which could be 2/3 below what you actually paid for it. Then the last product there, item number 7, we might have a look at that and figure that we'd actually be able to get our money back, and therefore that we're going to use market value and drop the overall cost by about 10% on what we paid for it. Now, this takes a bit of fairly realistic thinking and probably being a bit harsh on our products as we go through them. But what we can see from that is that the total stock value using this combination of methods gives us a stock figure of 315,000 in this example instead of 423. Now that will make for a reduction of 100,000 off this company's taxable income, and potentially a tax saving of $25,000 plus. So, or 25% of the difference between 423 and 315,000. So there's savings to be had in utilising this methodology because firstly, it makes our balance sheet more accurate because it's giving us a realistic picture of what the stock asset is actually worth. And secondly, it's making our tax position a lot more favourable because we're recognising the fact that some of our stock we couldn't sell for what we actually paid for it, and therefore picking up the tax savings that are had by using the correct methodology for stock.
Yeah, it's good, Gavin. It's definitely worth spending a bit of time looking at, isn't it?
Indeed, stock take certainly is a bit of an onerous task, as we know, but when we put it into this context, putting some thought and time into it can certainly make for some savings.
Definitely. Next one we thought we'd look at is your debtors listing. So you obviously it's something that should be kept on top of all the time. But June 30 is probably a good time to be quite realistic about what's on your debtors listing, whether it's actually recoverable, and whether it's it may be worth, putting away the time that you've spent pursuing it and just writing it off. So obviously a tax deduction can be claimed for the debt that you're writing off, as well as potentially a GST refund for the GST that you've paid on that sale. So it's worth being just realistic, as we said, about what's actually recoverable from your customers. If there's been something sitting there for a long time, it might be better just to let it go and write it off. So as you can see with this ABC company, once again, they've reviewed their listing. They found an $11,000 debtor, including GST, and the directors decide to write that off. So they get to claim the $1,000 GST refund in their next BAS, as well as a tax deduction when they lodge their next tax return. So that's effectively a $3,500 saving just by admitting that you've wasted your time trying to chase up that customer, and we'll move on and make the next sale. And it is important to note that it's only when it's actually written off to the profit and loss as a bad debt that you claim that deduction. It's not when you take up a provision for bad debts. That's just sort of normalising in case of that you have bad debts, but it's actually when it's properly written off to the P&L that you claim that deduction.
Yeah, it's good, Sam. We certainly hang on and hope against hope that we'll get our money, but in reality, we've got to go through our debtors listing and make that decision that in all reality, we probably aren't going to get it. Exactly.
It's a good time to do it this time of year. We also thought we'd look at a review of the fixed assets. So once again, similar to the debtors listing, it's a good time of year to run through your fixed asset register and check for any assets that might have been disposed of or are now obsolete and need to be written off. Because once again, you can claim a deduction for the written down value of those assets. So if we look at another example of this ABC company, once again, they've gone through their depreciation schedule, found with a fine-tooth comb, found $30,000 of assets at their written down value that can be written off, that have been disposed of or are no longer used or are obsolete, been scrapped. This will bring them a tax saving in this year that they write them off of $7,500, which it's worth doing. So it is just to point up that it is worth spending some time on your balance sheet, because there is opportunities often tied up there that can be unlocked. So Gavin's going to run through some tax opportunities in companies.
Yeah, that's good, Sam. Thanks for that. So I just wanted to touch quickly just on the loss carryback initiative. This was set on during the pandemic as a way to assist businesses that ran into loss situations. Broadly, the way it works is that we can normally speaking, you can carry forward a loss, which means that if you make a loss last year, you carry that forward to this year and then offset this year's profits with it. The loss carryback worked in the reverse, so it meant that if I had a profit last year and a loss this year, I could claim back the amount of tax from last year that related to my loss this year, provided, of course, I had paid the tax for that to a sufficient level in prior years. That initiative is winding up this year. And so I've just painted the picture here where we've got a profit of 300,000, say, in a previous year, and 2023 we've got a loss of 100,000. That means that this year that we can claim the carryback loss and claim back the company tax rate times my loss. So if I've lost 100,000 this year and paid tax previously, I can claim $25,000 tax back, which will come back to me as a cash refund of taxes paid in prior years. But certainly a very good initiative. And I think it's going to be very relevant this year to the construction industry. A lot of construction businesses have had a very good couple of years through COVID, but a lot of home renovation activity went on. There was the property boom following the pandemic, which led to a lot of development work. But we can see that the impact of interest rates and so on has meant that a lot in the construction industry have had a quiet 2023. And so there could be many situations where there's losses in 2023 and there was earlier profits. You will be able to use this concession. There is some conditions to be met, which are certainly worth looking into. But all in all, a very good initiative, and that is switching off after 30 June this year. So 30 June this year is the last opportunity that this can be utilised. Sam, you're going to give us a bit of info on trusts for...
Yeah, thank you. We thought we'd just touch on a couple of key points on trusts. Just things to be wary of and keep your eye out for the end of the year. So the key one we wanted to focus on is the trustee resolution. So obviously, trustee resolution is effectively a minute which the trustee sets out as to how the income in a trust is going to be distributed. And just a key note is that has to be done and signed before 30 June of the financial year. So it seems a little bit backwards that you're deciding who the income's going to before it is actually worked out how much income there is. But that's a really critical part of trust law, so we want to make sure we get that right. Obviously, the trust deed sets out who can be entitled to receive that income. The beneficiaries can include family members or charities or potentially, family companies. But yeah, we just want to keep labouring that point that the trustee resolution is required to be completed before 30 June, or else it could become void and the trustee may be taxed on the whole income of the trust, which is a outcome that we want to avoid pretty much at all costs. And then just a note that minors receiving no other income can receive distributions of up to $416 tax-free. So that's a nice little tax deduction there.
Not huge, but good.
Yep, absolutely. So this is just an example showing the worst case scenario if the trustee resolution wasn't done. So potentially, up to a bit over $200,000 tax could be payable by the trustee. And then potentially there'd be other tax when the individuals decide to take that out of the trust. So it's a really bad outcome. We just want to avoid that. So we just stress to read your trust deed, make sure you know who you can distribute it to, and then do that distribution minute before 30 June.
I'd just like to make the point too that if it's not made by 30 June, the ATO would have the ability to attack the arrangement and to then adopt a position that the income wasn't distributed and therefore should be taxed in the hands of the trustee at the top marginal rate for the whole lot of it. So very important to get this right and very important that it's done prior to June 30.
Absolutely. So I think Gavin is going to run us through a couple of notes as to the long-term tax impact of these stimulus packages we've had over the last few years.
Yeah, so tax-wise over the last couple of years, we've had some good initiatives running as a result of the pandemic, which have certainly helped. there's just a couple of long-term impacts that we just want to touch on just for awareness. Firstly, as a result of the instant asset write-off, it's going to make for very limited depreciation claims in future years. So going forward, you may have had assets which have all been written off because you've taken advantage of the instant asset write-off and temporary expensing initiatives. This is good at the time, but as you go forward, you don't have a regular depreciation claim to offset income with. So we can expect a bit of pain from a tax perspective over the next few years as depreciation claims go back to how they were treated post-pandemic, and new assets will just be depreciated according to the ATO's rates, but there will be no further depreciation in the claim going forward on assets that have been written off under those COVID initiatives. The other thing that will include is when assets that have been written off are sold, the full amount of that income will be taxable. So I guess just to cite an example there, you might have bought a work truck, for example, for $70,000 during the pandemic and written that off, and let's say it's now worth 50, and you go and buy another one that's worth, say, for example, $80,000 and trade in the old one and get 50 for it. Well, that $50,000 is going to be fully taxable income, and the $80,000 you paid for the new one will be depreciated at the ATO's rates, which typically write vehicles off over about an 8-year period. So there's just going to be situations like that where there mightn't be any specific difference to your cash position, but you'll suddenly have a lot of tax to pay on the sale of assets that you wrote off. And that's something just to be aware of as we move forward. The other one was just particularly for companies, was the non-taxable government grants that we got. There was two key ones. There was a cash flow boost and there was JobSaver, both good and generous initiatives at the time. But where those were paid to companies, the taxing of that could be quite different when it finally goes out as dividend, because normally a dividend, when it's paid, the tax the company has paid goes with that dividend. So you might have a profitable company and you take a $100 dividend out. That consists of the $25 tax credit that the company's paid and the $75 of remaining retained earnings. So if I receive a dividend, I can claim a tax credit for the tax the company's paid. If I'm winding up a company and I've been a recipient of some of these tax-free initiatives, I'll have no tax paid by the company to offset it with. So when that is paid to me as a dividend, that is going to be fully taxable income in my hands with no ability to claim a company tax credit against it because the company didn't pay any tax on that in the first place. So it was sweet at the time. We sort of all happily put our hand out and took these tax-free payments, which were good and certainly helped at the time. But there is going to be a bit of a sting in the tail if I get to a position of wanting to take those payments back out of my company as a dividend.
Yeah, absolutely. Yeah, that's good. So I think you had some ideas around financing equity payments. Could you run us through that, Gavin?
Yes, I just wanted to touch on your strategy that we've implemented a number of times and we think it works very well, which simply just looks at the fact that any business operates and uses assets, and the old formula of any balance sheet is that the assets minus the liabilities equal the equity the owners have. Now, as the name implies, the owner's equity belongs to the owners, and they, of course, have the right to draw that equity down at any time. But as we all know, cash flow doesn't always permit, and generally speaking, we have a combination of assets funded partly by liabilities or borrowings and then partly by owner's equity. And so we just sort of highlight this, just looking at trust that's clear enough on your screens there, but just looking at a very standard partnership balance sheet. So in this case, we've got ABC Trading, they've got cash in the bank and they've got debtors and stock, and they've got some equipment, and all in all, they've got total assets of about just under 1.5 million, and liabilities there of 519. So the owners of this business, which are John Smith and his brother Bob, they have combined equity of 956,000 each in a 50-50 split. Both John and Bob also have private home loans of $450,000 each, which are completely private. The interest isn't deductible because the purpose of those loans, of their home loans, is, as the name implies, for their private home, which of course, as we know, isn't a tax deduction. So one strategy that we have utilised in this case is for them to utilise borrowings to pay out their own equity. So as you can see in the previous balance sheet, there's $956,000 of equity there, which if they could pay that out would be enough to discharge their private home loans. So if they go to the bank as a partnership and they borrow $900,000, the bank can then step in and pay out that equity, provide funding to pay that equity out. They then take out $450 each and use that to discharge their loans. This leaves the liability with the partnership and the interest cost likewise, which is deductible, because for a partnership or a trust to pay out a beneficiary or to pay out partners' equity is a tax deductible purpose. And what drives the deductibility of interest is the purpose of the borrowings. It's not the name of the loan. It's not whether the bank call it commercial or whether the bank say that it's a commercial loan or whether it's secured by business assets or not. There's only one thing that drives the deductibility of interest, and that is the purpose of the borrowing. So in this case, as we can see on the highlight there, the bank have advanced $900,000 in borrowings. The partnership has then utilised those funds to pay out the partner's equity, which is a legitimate business cost, and the partnership going forward can then claim a tax deduction for that interest going forward. And at the same time, those funds have been drawn and John and Bob no longer have home loans. So it's a really good outcome, and it certainly does open a lot of opportunities and is very relevant to trust and very relevant to partnerships. Companies that can apply to, but we've just got to think through when that equity is drawn, it can trigger some dividends. So we just need to navigate the tax impact of that. But I think utilising banks to pay out equity is something that should be looked at by everyone. It's certainly an opportunity that's there and can be very tax effective. Sam, did you want to say something about the end of year checklist?
Yeah, that's good. So we've compiled quite a few of the points we've gone over in today's webinar into a pretty simple checklist that business owners can use to run through some opportunities that they have over the last 6 weeks up to June 30. So if you'd like a copy of this checklist, please just mention it in the survey that'll be coming out at the end of the webinar. We'd love your feedback, and we'd love you to get the benefit of this checklist that we've come up with. So feel free to grab a copy of that.
That's good, Sam. So that brings us to some questions. I'm not sure if any of you have questions you'd like us to answer. Certainly be free to pop those in the chat box if you have. I think we have, looks like we do already have a couple come in. Just have a look at these. Is there tax on superannuation paid into a fund utilising the downsizer payment? Good question. Yeah, good news is there's not. There's that $300,000 payment just goes straight into super. There is no tax paid by the fund when it gets there. It just simply goes in as a voluntary contribution. Of course, you can't claim any tax deduction for making that contribution. But the good news is that when it gets there, there's no tax payable by the fund. Other questions? Good question. Does prepaying super simply mean I'll miss out on the tax deduction the next year? Yes, absolutely. If you're prepaid in June, it means that the next year that you don't get to claim that specific portion of super. That said, the strategy can, of course, be repeated next year. So come 30 June 24, you can prepay the June 24 quarter super, and certainly you've got the opportunity there to repeat the strategy. The other thing is just simply the matter of timing. That I think in the example we had, was $20,000, wasn't it? And so we were working off 20,000 super benefit, which would result in a $5,000 tax saving. why would you not want to bring that forward? The ATO is not a good place to invest your money. So if there's a way to bring that forward and get the tax benefit in this year, certainly no good reason not to. I think that's about it for questions. If there's any other questions that we haven't gotten to, we certainly will make sure that we get an answer out to you on those. And I'd like to thank you again for joining us today. And thank you, and have a good remainder of your morning and good afternoon. Thank you.
Thank you.